Hello number curious friends, welcome to the channel where we talk accounting and finance. Today we move to another key question. When you buy something big for your business like a truck or software, you don't expense it all at once. Here comes depreciation and amortization. We have already discussed them in previous lessons, and today we will summarize the knowledge and add some more flavor to it. So, we have two types of depreciation of a non-current asset: depreciation and amortization. Depreciation is how we spread the cost of a tangible fixed asset over the years we use it. Think truck, shelves, Apple press. Amortization is the same idea for intangible assets with a finite life. Think software license, patents, customer lists. And these two apply only to long-term assets. That means if the thing will benefit the business for more than 1 year and the cost can be measured reliably, we capitalize it as a fixed asset. If it's short-lived or day-to-day, we expensed it immediately. The depreciation we have looked at with you already was straight-line depreciation, or amortization. It is the easiest method. Annual depreciation is defined as cost less residual value and divided by useful life. Let's have a look at the example, our delivery truck. We bought it for $15,500. That will be our cost. Let's imagine its residual value is 500. Residual value is the expected value of the asset in the end of its life. For example, we expect that we can sell it for 500 afterwards. Useful life of our truck is 5 years. Annual depreciation would then be 15,500 minus 500 divided by 5 equal $3,000 per year. Journal entry each year would be: debit depreciation expense 3,000, credit accumulated depreciation 3,000. T accounts in year 1 will be as follows: credit cash for purchase of a truck of 15,500, debit the truck at a cost at 15,500, depreciation expense 3,000, accumulated depreciation 3,000. Where does depreciation show up in financial statements? In the balance sheet, we keep the truck at cost and subtract accumulated depreciation to get the carrying amount, or net book value. In our case, after 1 year, the truck will show 15,500 cost, 3,000 accumulated depreciation, net amount or net book value 12,500. In income statement, it is often included in operating expenses and reduces profits. In the cash flow for indirect method, the depreciation is non-cash, so we add it back in operating cash flow. The cash happened earlier when we bought the truck and it appears in investing cash flow. What about amortization? For a software license that lasts 3 years and costs $9,000, straight-line amortization is 9,000 divided by 3 equals 3,000 per year. Journal entry each year is the same as for truck and depreciation. Debit amortization expense 3,000, credit accumulated amortization 3,000. T accounts would look the same too. Balance sheet will show the intangible asset at cost minus accumulated amortization. In cash flow, amortization will also be added back in operating cash flow as it is non-cash. Let's have a look at our truck for 2 years side by side. Truck's net book value over time will develop as follows. We start with $15,500 as cost. In the end of year 1, we have minus 3,000 and net book value of 12,500. End of year 2, minus another 3,000 and result of 9,500. In T accounts, you will increase accumulated depreciation to 6,000. Nice and predictable. That's why straight-line method is the most popular and the easiest to follow. But there are other methods, the most common of which are units of production and declining balance methods. For units of production, depreciation is based on usage, like liters of apple juice produced, kilometers driven, or hours used. For declining balance, we book more expense in early years, less later. So, when units of production method makes more sense than a straight-line method? Some assets wear out with use, not with time. If the benefit of your asset is linked to output or hours, match the expense to that usage. Let's have a look how it works. Depreciation per unit will be calculated as cost less residual value divided by total expected units. Depreciation expense in each period then would be depreciation per unit multiplied by units produced in that period. Let's have a look at an example based on our apples. The apple press cost us $12,000 with no residual value, and it is expected to press 120,000 liters in total. Then depreciation per liter would be $12,000 divided by 120,000 and equals 10 cents per liter. If we press 20,000 liters this year, depreciation would be 20,000 multiplied by 10 cents equals $2,000. If next year is very busy and we press 40,000 liters, depreciation would be $4,000. Why would we choose this method? This method offers better matching of cost with revenue when usage fluctuates. It is also useful for machines charged by hours, kilometers, cycles, liters or batches. And it gives us a clear cost per unit for pricing. And what is then to watch out? You need reliable usage data and a reasonable estimate of total units. And the administration effort for this method is a lot higher than for straight-line method. Now let's move to decline in balance. When does this method make more sense than the straight-line method? Some assets lose value or deliver benefit faster in early years. For example, technology becomes obsolete. Delivery vans are most productive when new. Repairs are low at first and rise later. Decline in balance method accelerates the expense to reflect that pattern. Let's have a look how it works. We apply a fixed rate to the book value each year, and common choice is double decline in balance. That means rate is double the straight line rate. And then you usually switch to straight line depreciation near the end of the life of the asset to fully reach residual value. Let's have a look at our truck as an example. We have a cost of $15,000 and useful life of 5 years. Straight line depreciation rate then would be 1 divided by 5 years equals 20%. Let's make it double. Double decline in rate equals 40%. What happens then to our depreciation? In year 1, our depreciation will be $15,000 multiplied by 40% or $6,000. In year 2, 40% will be applied to the remaining carrying amount. That means 15,000 less 6,000 depreciation from last year equals 9,000 remaining value. When multiplied by 40%, we get depreciation of 3,600. In year 3, the same logic. 9,000 minus 3,600 times 40% equals $2,160. And so on until we decide to switch to straight-line depreciation to complete the depreciation of the asset to zero at some point. Why would we choose this method? Decline in balance method offers better economic realism if benefits are front-loaded or resale value drops fast. It can smooth the total cost of ownership because maintenance is low early and higher later. It frequently aligns with tax rules that allow accelerated methods, but this depends on jurisdiction and policy. What to watch out? Early years show lower profits compared to straight line. This method is also slightly more complex to explain. Company policy and standards govern the choice of the method and any changes. So, we've looked at 3 different methods. How then to choose between different types of them? Pick straight line when the asset provides a steady benefit each period, or when simplicity is most important. Pick units of production when usage drives value and you can track units reliably. Pick decline in balance when benefits are front-loaded, obsolescence is fast, or policy requires acceleration. What's the difference in impact of different methods on financial statements? All methods produce the same total depreciation over the whole life. They only change timing, expense pattern and net book value development. Cash flow from operations is not affected by method in the short term because depreciation is non-cash. But tax cash flows may differ when accelerated methods are allowed. That means if you can deduct more depreciation as an expense, you will pay less taxes in earlier years, but more in the next. That total doesn't normally change. We will stick to straight line unless your course or company policy says otherwise. How is depreciation impacted by repairs and improvements? If upgrades qualify for capitalization, they will be capitalized and depreciated as part of the new total over the revised life. And remember, for intangibles with indefinite life like certain trademarks or goodwill, there is no routine amortization. Instead, we test for impairment each year. And now briefly, common beginner mistakes to avoid. The first one is expensing the full cost of an asset in year 1 instead of capitalizing. The second one is forgetting residual value in the formula of depreciation. The third one, depreciating land. Do not depreciate land. The next one, showing assets at cost but forgetting accumulated depreciation or amortization. And the last one, treating maintenance as an asset when it does not extend life or capacity. Okay, so for now let's summarize this lesson. Depreciation is used for tangible assets, amortization for intangible assets. Straight line method is cost minus residual value over useful life. Units of production and declining balance methods can be more suitable in some instances. Depreciation expense hits the P&L. Accumulated depreciation reduces the asset on the balance sheet. Depreciation is non-cash. Add it back in operating cash flow. Capitalize upgrades and revise depreciation charges over the new life and total. Thank you for watching. If you enjoyed this lesson, hit like, subscribe and ring the bell so you don't miss the next lesson. See you soon and keep those debits equal to your credits.